Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, November 8th, 2023. How you doing? Thank you so much for coming and watching another one of my weekend review podcasts. I hope you're doing well. I hope you had a good trading week. Hope you're enjoying your weekend. And boy, what a market we've had. Boy, this has been extreme, I think is the word really that comes to mind, this move to the upside. So hope you're participating in it. Hope you're trading well. And in today's podcast, this is going to be the format. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back. We're going to take a look at all the trades I made last week. We're going to talk about when I entered the trade, why I entered the trade, what setup, what strategy I was using to enter the trade, and most importantly, how I am going to manage the trade going forward, either to the upside or to the downside. It's very important in trading that you have a complete trading plan so that you know what to do regardless of what the market is doing. They're called if-then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. It makes it a lot easier to trade, a lot less psychologically difficult if you have an exact plan in place, so you don't have to just make a decision on the fly and go, oh, I think I need to get out, or oh, I think I need to get in, right? It's a much more holistic way to trade. And when it comes to trading, it's not just where I'm going to enter and where I'm going to exit. There's a whole handful of things that you need to consider. And in general, what I do is I look for if, like, say, we have a deep dip buy kind of setup, I need to look for the price to go down and reject a key level. Sometimes that level's the 30 RSI, sometimes that level's the 250-day moving average, sometimes it's the 300-day moving average, sometimes it's the 250-day moving average. And what I want the market to show me is that it is testing that level and rejecting that level. And if it rejects that level and it gives me a good risk to reward ratio, then I have to position size correctly for the volatility of the market. Sometimes the market volatility is very low. So the formula that I use, and I'll show you this today in the podcast, will have me buy more shares. If volatility is higher and the expected move is larger, then I have to compensate with that by buying fewer shares because the volatility is higher. So look for that rejection of that level. Make sure it's a good risk to reward ratio, position size correctly based upon the volatility. And again, I will show you that. Then I have two stops that I use. I use an emergency stop, which is exactly 2 ATRs away from my entry. And when I show you some of the trades here that I took a trade yesterday. I'll show you exactly how I do that. But I always have two stops. I have an emergency stop. That is in place for the worst case scenario. And even if the worst case scenario happens, I'm only going to lose 1% of my account. But that only happens 5%, about 5% of the time. The other 95% of the time when I have a losing trade, it will be because my end of day stop was triggered. And so if I was rejected at the 30 RSI, or if the price rejected the 30 RSI, for example, then if the next day, if it closes back below the 30 RSI, I'm just quickly out. No questions asked. I'm just quickly out, and most likely for a very small loss. Then as price moves up, I take partial profits, not the entire position, obviously, but a small amount of profit to the upside if it moves 0.45 ATRs from the previous bar's close. And again, I will show you this. I'm just kind of laying the groundwork here, but I'll show you this. Then if we get to trailing stop level, which is 1.5 ATRs above my entry, then I start to tighten things up. Then if I have a close below a previous bar's low, I'm just going to get out of half. It's a precautionary measure. Again, if it keeps moving up and keeps moving up, then I continue to take partial profits until we get to some kind of extreme levels, like a 65 RSI level, in which case the 5 EMA comes into play. If we reject the 70 RSI level, I'm going to take another half off because 92% of prices fail at the 70, stop going up at the 92 I'm sorry, at the 70 RSI level. And then I have some other rules that I'll show you. And with this SPY position that I have, it's perfect. It's perfect teaching example. So look for those rejections of certain levels. You look, you position size correctly based upon the volatility. You have your 2 stops in place. I take partial profits as it moves up until we get to certain levels. So, you need a complete program. You need a complete trading process, whether you're long or short. I took a short position on Friday. I'll show you that. So we'll look at all my trades, when I entered them, why I entered them, how I'm going to manage them going forward. I trade on both the daily and the weekly, sometimes the monthly. Haven't had a monthly trade for a while, but we'll go over the daily trades, we'll go over the weekly trades, and we'll see how they're doing and how I'm managing that. After that, we're going to talk a little bit about trader psychology. Really, the most important skill in trading, everyone, is the ability to create a plan and follow the plan. You can have the best trading plan in the world, but if you don't follow it, it doesn't matter. Right? Why even have it? So I always like to cover trading psychology. It's always helpful for me to teach it, and I hope it's helpful for you as well. All right, and then after that, I have gone down through my master watch list, both on the daily time frames and the weekly time frames, and I have identified some trades that I'm looking for next week. They're not where they need to be yet. A lot of them are close, but if they get there next week, then I will consider taking the trade, and I have them both on the daily and the weekly time frames. And I do have some potential short positions as well. And I would like to add, I will go over some of the indexes, just kind of big picture market observations here. And I'll show you why I think we are very close to at least a short-term top. And that's why some of the potential trades that I'm looking at next week are to the short side. All right, so give you an idea of what I'm looking for next week, give you an idea of where these markets have to go in order for me to consider getting in a trade. So I hope it's going to be helpful. I hope you're going to learn something today. And to get started, I've got to run that U.S. legal disclaimer first. So let's get that out of the way. I'll be back in about 40 seconds and we will get started. Hold on, and I'll be right back.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All righty. Thanks for holding on, and let's get to the trades of last week. All right, let's start off with SPY. So I had a great trade on SPY. I bought SPY all the way back here on the 27th of October, right near the lows. Why did I buy this? Well, the technicals told me to buy this. And, when it comes to taking my trades, the more signals that you have, the more confluence or combination of signals that happen at the same time, the better chance you have to have a profitable trade. Doesn't mean that if you have great signals line up that 100% you're going to have a trade, a positive trade. Absolutely not. But it does help improve the odds. So I did get long SPY all the way back here at 414.80. Okay, well, what were the signals that I took? Well, the first signal, you see the orange line here. This is the 300-day moving average. This is a key level that large financial institutions and savvy traders key off of. Well, the day before, on the 27th, we closed below. And we also got to the negative third ATR channel, which is important. Because 92% of prices tend to stop going down at the negative third ATR channel. But I'm not going to buy, and it was under the 30 RSI. The next day, the day that I bought it, lots of things happened. We closed under the 300, we closed above. That was one signal. We closed under the 30 RSI and we closed over the 30 RSI. In addition to that, we had a double bottom with the bullish divergence. You see the MACD here. This one's deeper here at this low. Even though this slows here, this one was not as deep. So this is called the double bottom bullish divergence. So there are all sorts of signals that we're lining up here. Close under three, or close below 300, close over the 300, close under the 30 RSI, close over the 30 RSI. So those were my signals to enter. And then, as I mentioned, we have two stops. I use two stops, an emergency stop and an end of day stop. Well, the emergency stop and the position sizing, let me show you real quick. It's based upon the way that I do it. It's based upon your account value. So let's just say you have a hypothetical $100,000 account. 100,000 times 1% is 1,000. So I would take $1,000, divide it by whatever the 2 ATR value was at the time. Right now it's 993, but back here it was a different amount because it moves every day. But let's just say it's 993 divided by 993 tells me under the current volatility to buy 100.7 shares. So I can't buy that. I can just round it up to 101. So let's just hypothetically, when I bought this, let's just say I bought 101 shares. Okay, 101 shares, $1,000 divided by the value of the 2 ATR. If you have 50,000, then 1% is 500. And so you would have half of that. If you have $1 million trading account, 1% is 10,000. You would divide it by the 2 ATR, and that would show you how many shares to buy. So did the math on the position sizing, and the 2 ATR was 993 that I used in the math. Well, I just take that number, and that's exactly, I put it 993 below my entry, whatever my entry price was, put a line down here, 993 below. So that means if I have 101 shares and it moves $909.93 to the downside to my emergency stop, then I lose the $1,000. Now, in my trading, I base everything off of end of day close because the end of day close is the most important closing price, in my opinion, because the large financial institutions come in at the day, they move the market to where they want it at the end of the day, and that closing price is the most important. But if I ever get to my emergency stop, which is the 2 ATRs below that, I'm going to get out of that if that's 1 minute after the market closes in the middle of the day, or 1 minute before the market, or 1 minute after the market opens in the middle of the day, or 1 minute before the market closes, because that is the maximum I'm allowed. Now, it's very unlikely that it's going to go down here because it's 2 ATRs away from your entry. And there's only about a 5% chance at the time. But if it does, and it does happen, trust me, then I just get out immediately. But my end of day stop, I wait till the end of the day. Well, why did I take the trade? Because it went under 30, over 30, under the negative 300, over the negative 3, over the 300 SMA. So bought it here for 14.80. If in the future, if it had just closed below even 1 penny below the 300-day moving average, I'd simply be out for a small loss. It's not going to be $1,000, only $1,000 if it gets to here, right? But only a 5% chance that that's going to happen. So waiting for a close below the 300-day. But luckily, it never happened. So saw the rejection of the level, position sized correctly, placed my emergency stop below. I know where my end of day stop is. Then these are all defensive moves. I'm concentrating on the defensive moves first. Now let's talk about offensive. You have an orange line up here. What is that? That is my 1.5 ATR trailing stop level. It's exactly 1.5 ATRs above my entry. Remember, my emergency stop's 2 ATRs below. My trailing stop level is 1.5 above. So if I ever get there, then I go into what's called trailing stop mode. So I can tighten up my stop. As it moves up, I want to tighten it up because I don't want to give it all the way back. So as soon as I get to this orange line, or in other words, 1.5 ATRs above my entry, then I go into what's called trailing stop mode, which means that if I have a close below a previous bar's low, after that, I will get out of half, which happened up here. But let me take you through the rest. So I mentioned that I always take partial profits. I always take 10% of the remaining position I take 10% of the remaining shares that I have as profit targets if it moves 1.5 ATRs from the previous bar's close. So I'm still in this trade. Right now, the closing price is 450.79. So I take 450.79 and I add the value of the 0.45. Right now it's 223. So I take 450.79 plus 223. On Monday, that will be my first profit target, 453.02. And if it reaches that, I will take 10% of however many shares I have off. Now, I always set 3 profit targets. So this is my first one. So I take my first one, add the 0.45 ATR value to it again, plus 2.23. 455.25 will be my second profit target. Then I take my second profit target, I add it again. 457.48 will be my third profit target on Friday. And I always have 3 in the system. All right. Doesn't mean they have to hit, but they're in there in case they hit. So as you can see, when I took the trade, the next day it went up, but not enough for a profit target. Next day it went up, I took more off. I take some profit off, reduce the position size. By doing so, I reduce my overall risk. Market can't take that away from me. Next day up again, 2 profit targets. Next day up again, another profit target. Now I'm in trailing stop mode, which means now in the future, if I have a close below a previous bar's low, I will get out of half of the remaining. We had 3 days kind of dribbled up, but not enough for a profit target. And then here on the 9th of November, I had my first close below a previous bar's low after reaching trailing stop level. However many shares I had, I took half off with a gain of 4.38%. It's a precautionary move in case it had come back down, but it didn't. It continued to move up. Now I'm up. I believe this was a 2 profit target day, maybe 1, can't remember. Next day didn't do anything. Next day moved up strongly again, took 2 more profit targets. So you see I'm continuing to reduce my position size as we get higher and higher. Then here on the 15th of November, we rejected the 70 RSI. Intraday, we went above it and then closed below it. So I took another half of whatever I had remaining off. And very high percentage of prices, 92% of prices, when they get to the 70 RSI, they stop going up. And you can see ever since that has happened, yeah, we dribbled up a little bit. So anyway, on what was it, Wednesday, I took another half of what I had off for a gain of 7.7%. Now it becomes very easy. Now, because we've rejected the 70 RSI, now in the future, if I have a close below a previous bar's low, I'm just simply out of the trade. And if you're listening to this podcast for the first time, you're probably going, man, he has a ton of rules. And I do have a lot of rules. I've been trading for 28 years, and every single rule I have in here, there is an absolute reason for it. And if you would like to learn to trade like I do offer private one-on-one lessons in the evening time via Skype. I have taught people from all over the world, from absolute beginners to hedge fund managers and everywhere in between. I love to trade. In my one-on-one course, I teach you all 5 of the different trading approaches that I use. I teach you them step by step. I'm very patient. I believe I'm a very good trader from what very good teacher from what my students are telling me. So if you are interested in becoming a better trader, in learning to trade exactly how I trade, my email is in the link of this description. All you have to do is send me an email. We can start the dialogue. But the course costs $1,750, but it's worth every penny. It's an investment in yourself, and it's investment to learn a new skill. And the methods that I teach, they're really good. They are really good. So if you're interested, please send me an email. So back to the charts now, because we rejected the 70 RSI, now if I get a close below a previous bar's low, I'm just simply out of the trade. And, it's all about risk to reward. Look, I bought all the way back here at 414.80. if in the future it had just closed slightly below the 300, I'd just simply be out for a small loss. And that's what trading is about. Buying or shorting at key levels, and if you're wrong, being wrong quickly and getting out. You have to be very impatient with your losers and very patient with your winners. And you'll see from all the trades that I'll show you, if I'm in the money, I am in that trade. I'm patient. I have a process, obviously, but I'm patient with that. But the losses that you see me have, I will be out quick. So very impatient with your losers, very patient with your winners, and then again, having a process to show you what to do. So have a quarter position left on SPY here. In the future, if we get a close below previous bar's low, I'll simply be out. But on Wednesday, I closed out half the remaining position I had at a 7.7% gain, which is really great. Let's go to Caterpillar. All right, so I kind of laid the groundwork for you with that SPY trade. Go through these a little bit quicker, but I did get long a Caterpillar back here on the 1st of November. Why? Again, confluence combination of signals. The previous day we were under the 30 RSI and we were under the 300-day moving average. The next day when I took the trade, it went under 30, over 30, closed under the 300, over the 300. I got long here. 231.60. I position size correctly. I placed my emergency stop 2 ATRs below. Again, my end of day stop, if it simply closed below the 300, I am out. And look, when I took the trade, it was barely over the 300. So in the future, if it had just barely closed 1 penny below, yeah, I'd just be out for a small loss. You never know what's going to happen, but you have to have these asymmetrical risk to reward ratio. So if you're wrong small, and if you're right, you have the possibility of being right big. Okay, so got long here at 231.60, position size, orange line. What's that? That's my 1.5 ATR trailing stop level. If I get there, I go into trailing stop mode. Next day moved up, took some partial profits off, reduced the position size, reduced the overall risk. Next day moved up again, took another partial profit off, did get to trailing stop level. Now I'm in trailing stop mode, which means if I have a close below previous bar's low, I get out of half. Next day, barely closed above, so it kept me in. Next day did close below the previous bar's low, sold half of what I had remaining for a gain of 1.31%. And then we had a few days of kind of moving sideways, and then we moved up, more profit targets, moved up again, more profit targets, moved up again, more profit targets, moved up again, more profit targets. And on Friday, hit another profit target as well. We're at 55.09 RSI. If I get into the 65 range, then the 5 EMA comes into play. If we reject the 70, then I'll sell half, just like I showed you on SPY. But the second half of this particular trade that I have remaining, up 8.49%. And it's a perfect example, everyone, of having a confluence of signals, position sizing correctly, having a very good risk to reward ratio. And this one worked. Up nicely, up 8.41%. All right. Diamonds. This is the Dow. I did get short on Friday, the diamonds. And why? Well, so this is called an order block. This is the highest close we had before we had a break in structure. And I know that sounds complicated. This is something that I teach in my lessons, but it's a little complicated to go into depth and into detail here. But we had a market structure change here, and so I look for the high of before the structure change happened. Here it is. The low here, 384.70, the high, 350.60. Anywhere in here is legitimate to short. I did get short here on Friday at 349.70 because of the rejection of the top of the order block and because we went over 70 and under 70. That's not a great sign either. So is this short going to work? I have no idea, but I know exactly what I'm going to do regardless of what the market does. I did see it reject the top of the order block. I did see it reject the 70 RSI. I know what the statistics are, that it's more likely to go down than up, but in case it does go up, that's fine. So I position size, I place my emergency stop 2 ATRs above because I'm short, And where is my end of day stop? My end of day stop is just simply a close over this order block of 350.60. Right now we're 349.40. So it's like $1.20 to the upside. Monday, if it closes at 350.61, I'm simply out for a very small loss. In the worst case scenario, if it goes melting up and we get up to my emergency stop, I simply lose 1% of the capital. Not fun, but I can recover from that. So to the downside, 1.5 ATRs below my entry because I'm short is where I will go into trailing stop mode. And if it moves down, I will take partial profits. Right now it's 349.40. Let me give you an example of this. So the closing price 349.40 minus the value of the 0.45 because I'm short minus 1.5. My first profit target to the downside, where I'll take 10%, is 347.90. So if it goes to 347.90 on Monday, I will take 10% off. That's my first profit target. How do I get my second? Take the first profit target minus the first profit target, $1.50, 346.40. That'll be my second profit target on Monday. Third, 346.40 minus 1.5. That will be my third profit target. All right. And if I get to my trailing stop level, then I go into trailing stop mode, which means if I have a close above a previous bar's close, I will exit half. So again, did get short here, 349.70. It's 349.40. So I'm slightly in the money already. But the reason was because we rejected the 70 RSI and we rejected this order block. All right. So there's a short position and then USO. Good, really good teaching example on this trade of why it's so important to take partial profits and why it's so important to have trailing stop rules. And you'll see exactly why that helped me out so much on this trade. So I did get long here. It ended up being a losing trade, but good example. I did get long back here on the 8th of November at 70.10. Why? Because of the bounce at the 200-day moving average. So I position size, place my emergency stop below. My end of day stop is simply a close below the 200-day moving average. I place my 1.5 ATR trailing stop level above. And then again, of course, if it moves up, I start to take partial profits. So 70.10 is where I bought it. Next day moved up, took some profits. Next day moved up, took some more profits. Next day moved up, took some more profits. Then the very next day here, I think I hit a profit target. I don't remember, but I think so. On this day, I got to trailing stop mode, which means now if I have a close below a previous bar's low, I get out of half. Next day, that happened. We have a close below a previous bar's low after reaching trailing stop level. I took the partial profits on the way up, which was helpful, as you'll see. And then because we got to trailing stop level, closed below previous bar's low, got out of half for a gain of 1.86%. On Thursday, boom, we closed below the 200-day moving average. I had to get out of the trade, right, because that was my end of day stop. And the remaining shares, I had a loss of 2.6%. But overall on the trade, did I really lose 2.6%? No, because I took profits here, I took profits here, I took profits here. I think I took profits here. I got out of half of the remaining with the close below the previous bar's low at a gain of 1.86%. So the remaining shares that I had that closed below, I'm simply out. And then Friday, boom, right back up. Rude, but that's okay. That's what happens. But I am considering buying USO again next week. I have it on the list of the potentials, and I'll show you why. So the remaining shares on here, loss of 8 or 6? 2.6%. All right, so real quick recap on the dailies. Remaining shares on SPY up 7.7%. Remaining shares on Caterpillar up 8.49%. Diamond slightly up, just took the trade, barely slightly up, but just took the short trade. And then USO remaining shares are out of the trade with a loss of 2.6%. All right, let's go to the weekly trades as well. Weekly, I take weekly trades on Friday because that is when the weekly bar closes. And this is gold, GLD. back here on the 6th of October, why did I buy GLD? Well, black line should probably give you an idea of why. During the week, we went below the 200-day moving average. At the end of the week, we closed above it. I got long 169.70. I position size. I placed my emergency stop. My end of week stop is what? Well, I got in because it rejected the 200-day. Therefore, if the next week had simply closed below the 200-day moving average, I would have just gotten out of the trade, right? I placed my trailing stop level 1.5 ATRs above. So if I get there, now I go into trailing stop mode. And of course, I set my partial profits to the upside from the previous bar's close. Next week was a monster to the upside. I hit, I can't remember, 2 or 3 profit targets to the upside, reduced the position size, locked those in, reduced overall risk by doing that. Next week, moved up again, hit another 2 profit targets. So reducing my position size as things move up. Got the trailing stop level on that first week as well. Next week moved up, not enough for any profit targets. Next week, sideways movement. And then 2 weeks ago, I had my first close below a previous bar's low after reaching trailing stop level. So I got half of my remaining shares for a gain of 5.71%. And then this week, hit 2 profit targets again to the upside. Took the closing price of last week's bar, added the 0.45 ATR. So I always put 3 in, hit 2 of those, took more off, and the remaining shares here on GLD up 7.67%. Pretty good trade. Pretty good trade. And then last but not least, XLF. Okay, I've been talking about this trade forever. Why? Well, I've been talking about this trade forever because I've been in the money on it. Remember, if I'm in a trade a long time, it's not because it's a losing trade. It's because it's a winning trade. If I'm in a losing trade, I am out quick. All right, let's talk about XLF. I have been in this trade since March of this year, March 24th. Why did I take the trade? 250 week moving average. This is the purple line here. During the week, it bounced right at it, closed above it. I got long here 30.71, position size correctly, got long here 30.71, placed my emergency stop 2 ATRs below. My end of week stop is where? Just a close below the 250, placed my 1.5 ATR trailing stop level above, and then taking partial profits on the way up. Next week, moved up, took some partial profits. Next week, nothing. Next week, moved up again, took more partial profits, got to trailing stop level. Then we kind of came down, but we never had a close below a previous bar's low. Never, until here on the 23rd of June was our first close below a previous bar's low after reaching trailing stop level. Got out of the remaining shares that I had for a gain of 6.4%. And then we had a month or longer, 5 weeks of up. Took profit targets. Nothing here. Took profit targets. Nothing here. Or here. Took, I believe, 2 profit targets. So continuing to take while the getting is good. And then we had this several, 2.5, 3 months of just downward. Look here. If this week would have closed below the 250, I would have simply been out. But it closed above, so it kept me in. Next week, screaming bar up, took more profit targets. This week, screaming bar up, took some more profit targets. Remaining shares here that I have on XLF up 12.28%. So those are the only weekly ones. Weekly ones, gold, remaining shares up 5.71% on the weekly trade. And XLF remaining shares up 12.28%. So really good results, really proud of those. Is it I'm so smart? No. It's just that I just saw the market reject key levels. I positioned size correctly. I got in, and then I just followed my progress or my process, and it told me what to do. I didn't get emotional. I didn't get compulsive and go, oh, that's enough. I had a plan. And you need a plan either to the upside or the downside. And like I mentioned before, in my one-on-one classes, I teach you the plan. You will never know, you will never not know what to do. And so that's why I really highly recommend this course, because you learn an actual real trading process that uses all good trading principles. All right. All right. Hey, let's talk a little bit about trader psychology, shall we? It's so important. This is from Stephen Goldstein. Great person to follow over on Twitter, over on X at AlphaMind101. Stephen has a great podcast. He interviews traders from all over the world, all different types of traders at all different levels. He's a professional trading coach. And so when Stephen writes something, it's worth a lot. You should read it. So follow him, AlphaMind101. Like I said, he has these great podcasts. I was lucky enough to be interviewed on his podcast twice. And so appreciate that, Stephen. But let's see what Stephen has to say. All trading involves analysis, but analysis isn't trading. It's part of it. One of the biggest sources of failure is an over-focus on analysis at the expense of focusing on risk-taking. Risk-taking is the major part of trading. It's where the rubber meets the road. Work on it. It's so true, everyone. That's why when I was showing you, kind of the setups that I had just taken, I focused on the risk portion first, the properly position sizing based upon volatility, having that good risk to reward ratio at your end of day stop, having that emergency stop in place in case it all hits the fan, taking partial profits as it moves up. Why? What does that do? Well, it continually reduces your risk by taking partial profits off, right? It's if you have a big down move after that, you've mitigated the risk by taking partial profits while the getting was good. So it's all about risk. It's all about risk, everyone. You need to focus on the risk side. If you never take a loss, which of course will never happen, but if you do everything that you can do to reduce your potential losses, that's the number one thing you can do to not blow up an account. If you follow your process correctly to the upside and just let the market do what it's going to do, you're going to make money. But people, a lot of people some people are great with just letting their profits run, really great at it. And that's fine, and that's great. But what you have to do is get out quickly when you are wrong. Risk, mitigate, manage risk all the time. That's the key. If you have a really big loss, boy, it is tough, both financially and emotionally. That's why it's so important to set everything up so that you are managing that risk taking with good risk to reward ratios, with proper position sizing, with signals that you know exactly what to do. All right, so one more time. All trading involves analysis, but analysis isn't trading. It's part of it. Yes, you need the analysis. Yeah, of course. Where are the setups? Do you have a good confluence or combinations of indicators lining up on multiple time frames? Yes, of course. This is what I teach, right? That is important, but what's at the end of the day, what's really the most important, because you can have the best setup in the world, it doesn't mean it's going to work. And if it doesn't work, are you strong enough to go, oh, I was wrong, I'm out, I'll wait for another setup? So yes, there is analysis, there is looking for combinations, confluences of signals. It's a very important part, but at the end of the day, the risk portion, the risk management portion is the most important. As traders, we are risk managers. If you focus on the risk and avoiding the risk and avoiding losses, the profits will come by themselves. But if you focus on the gains and forget about the risk, that is when you are in trouble. So thank you, Steve. Please follow Steve at AlphaMind101 over on Twitter. All right, here we go. So on the dailies for next week, this is what I'm looking for. I have quite a lot of potential short signals for next week. Yeah, we definitely have had a big rally here. Definitely could continue, but we're getting into some levels that historically, and some setups that historically are hard to overcome to the upside. This is Google that I'm looking for. Earlier, I spoke about that I shorted diamonds, DIA, because we rejected an order block. Well, here's an order block over here that happened on 10/24/23. This was a big up bar before a market structure change. So next week, I am considering shorting Google, GOOGL, if we close inside of this gap in between this orange line or this orange line. I'll wait until the end of the day. Hopefully it will be higher than lower, but if we were to reject this level here, 137.40, I would get short. I almost got short on Thursday. You see how close we got to that level, and then on Friday, obviously we moved back down. So what I'm looking for next week for a potential short is Google somewhere in this gap between 137.40 and 139.40. So potential short in this area. Of course, I would position size. I would place my emergency stop 2 ATRs above. Where would my end of day stop? Just would be, or where would my end of day stop be? Simply it closed below the high of this order gap at 139.40, just like I showed you on DIA. So potential short for me here in this area on GOOGL. Right here, somewhere between 137.40 and 139.40 potential short. Russell. All right, another potential short. Key moving average here is the 200-day moving average. This is the black bar here. I don't like to short unless it's an order block. I don't like to short unless we get a lower high kind of short. You always hear me talk about higher lows. Higher lows are much better long entries than lower lows. Just like this low was higher than this low and it really moved up, right? So if next week we were to reject this 200-day moving average, either intraday just bounce at it, bounce down, or go above it, close below, or close above it and close down below. If it's lower than this high here, anything, see, this would be a lower high. This, if it goes above, then it negates the whole thing. But if we reject the 200-day next week, I would consider shorting IWM as long as it's a lower high. And then, so let's just say Monday it goes up, goes above it during the day and closes back below it. Well, that would be my short. I'd position size, place my emergency stop above. Where's my end of day stop? Just simply if it closes above the 200-day moving average. So IWM is another potential trade for me next week to the short side with a rejection of the 200-day moving average. McDonald's. Well, here we go. I am looking for a short. Look, over here is a order block between 277 and 280.40. And the bottom of that order block coincides with the 200-day moving average. I almost shorted this on Friday, but you see how we didn't quite reject the 200-day moving average. If we were to rejected it, I would consider taking the short. So as you can see, I am a little bearish here, but I'm not just going to go ahead and short. I'm going to wait for real legitimate signals. And so another potential for me here on McDonald's would be a solid rejection of the 200-day moving average to the short side. Doesn't mean it's going to work, but it gives me a very good risk to reward ratio. And that's the key. We also have a fair value gap, a major fair value gap from here to here that coincides with the 200-day moving average as well. So I'm considering that. S&P. So this is a tricky one for me because I am in this trade to the long side, but there's a huge fair value gap from here to here. I highlighted it here from 451.08 to 455.70. This is a clear shorting area here because of the fair value gap. Now, I am in the trade, so what am I going to do? I don't have a lot of shares left. I mean, I could get out of this trade right here and right now and be fine with it. But I'll just have to see next week what I'm going to do. But if I was not in a trade right now, if I was not in a trade and we ended up someplace in this area next week, I would, me personally, I would short if things look good, and I would use the previous high here as my end of day stop. So I'm in this trade. I'd like to just let it play out exactly to my process, but I'm torn because this is a very dangerous area. And of course, look at this move. I mean, you would expect a little bit of an up move as well, but I am definitely considering getting out of my entire position here and switching to the short side in this area here between 451.08 and 455.70. All right, let's talk about something to the long side. Well, on Monday and only Monday, you see we had a big gap down here. If Monday, for some reason, we gap up, this will be a abandoned baby, a bullish abandoned baby. Similar to this. See how we gap down and then we immediately gapped up? And if you'd like to learn more about abandoned babies or island reversals, I know funny names, right? But go to my YouTube channel in the lessons playlist, totally free. And I have a video there about my new favorite trading, one of my new favorite trading approaches, abandoned babies and island reversals. You can see they're quite accurate. Look at this. Abandoned baby to the upside. It worked. Abandoned baby to the downside. It definitely worked. Abandoned baby to the upside. This one didn't work. They don't always work. Let me show you another example as well. I did this for a student of mine. This is on INDA. Abandoned baby to the downside. Look, a gap up followed by immediate gap down. That's bearish. Was it bearish? Oh, yeah. Look, the abandoned baby here. Gap down followed by the immediate gap up. Was that bullish? Yeah, I would say so. I would definitely say so. So now you can see why I am looking for potential, but for Monday only, guys, right? We had the gap down. If there's some good news over the weekend for some reason and natural gas gaps up, leaving an abandoned baby, I would definitely consider taking that trade. Same thing. I had a position size. I put a 2 ATR stop below me. That's my emergency stop, or a 4 ATR profit target above. One of the two are going to happen. I'm either going to lose 2 ATRs to the downside, or I'm going to gain 4 ATRs to the upside. That's the approach that I take here. Oil. All right, so I already mentioned oil. I had to get out of that on Thursday, but now we're back above the 200. Did I take the trade? No, I didn't. I didn't take the trade, but what I would be looking for next week is a little bit of a pullback at backfill to retest this 200-day moving average to give me a better risk to reward ratio. That is what I would be looking for. It's a legitimate entry just as is, but I didn't take it. I wanted to see if we might get a little bit of a pullback and give me a better risk to reward ratio to the 200-day moving average. And then last but not least, Walmart had some bad news. Things can change quick in the market. Look at this up here, and boom, earnings all the way down here. What do you think I'm looking for on Walmart? You are right. I'm looking for some kind of rejection at the 200-day moving average to show me that, okay, we've tested the 200-day moving average. There's no more sellers under the 200-day moving average. Give me a good risk to reward ratio, position size, emergency stop below, end of stop, simply close below 200. And if it moves up, continue to take profits. If it gets the trailing stop level, then a close below previous day's low, I get out of half, so forth and so on. So not a lot of long positions here. I would be very careful, everyone, just in my humble opinion, about chasing this rally. As I've mentioned, we've gotten to some key levels of resistance to the upside. Who knows? It may continue to the end of the year, but statistically speaking, we're stretching the rubber band pretty tight. So real quick recap. And by the way, everyone, all of these signals could trigger on Monday or sometime next week. Would I take all the signals? No. I am only going to take one of the trades per day. So if all 7 of these were to trigger for some reason, I would have to pick the best one. And how do I pick the best one? Which one has the most confluences and combinations of indicators lining up? What was the market, the relative strength of that market compared to the rest of the market? What's the risk to reward ratio? How does it look on the higher time frame? A lot of times you may have something on the daily, they all look great, but then if you go to that higher time frame to look for additional support or resistance, you'll find something that's very clear to you that, oh, this one is the best one on the higher time frame. I like to look at multiple time frames. And again, this is what I teach in my class, how to narrow down which one has the best report card. Maybe they all have A's, but one has an A plus. Well, that's the one that I'm going to take. All right. So real quick recap here. Google, looking for a short somewhere in between 137.40 to 139.40. My stop would be a close above this order block here at 139.40. Russell 2000, looking for a potential lower high rejection of the 200-day moving average. McDonald's, looking for a rejection of the 200-day moving average inside of this order block. Potential there. SPY, looking for some kind of short in between 451.08 and 455.70. My stop would just be the high back here in July. Natural gas, Monday and Monday only. If we get a abandoned baby to the upside, which would mean Monday it would have to gap above the high of 618. Oil, looking for a bit of a pullback to the 200-day moving average, and Walmart, rejection of the 200. So those are the dailies. And by the way, if you're enjoying this today, if you're finding some value in this today, I would really appreciate it if you could hit the thumbs up button. Just takes a second. It's totally free, and it really does help out the channel, helps keep the channel around, lets YouTube know there's some valuable content here. And the only way they know that is if they get thumbs up button or a comment, right? So those are the dailies. Let's take a look at the potential weeklies. I've got a few here on the weekly, starting with Apple. This is a short. Why the short? I am looking somewhere between 191. Oh, sorry. Yeah. Order block here between, oops, sorry. Between the low of 191.74 and 196.80. I'm looking for a short somewhere in between 191.74, 196.80 on the weekly. Position size, 2 ATR above. Stop would just be making a new high. Berkshire Hathaway, looking for another short in between 365 and 371.20. Again, here's the up order block right here, 365, 371.20. If we close anywhere in this level on Friday, that would be my short, with my end of week stop being high of day here. And last but not least, VIX. VIX's volatility, you can see it has gone down, 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 down. I mean, look, when you look at the daily, look at this VIX. Unbelievable. So if you see something like this, you know the market's going up. So therefore, I am looking for a signal. Right now on the weekly, the RSI is 3109. I'm looking for some kind of rejection of the 30 RSI to the downside, which makes sense, right? Because I'm getting bearish on the stock market. That would mean I'm getting bullish on the VIX. So we're at 3109. Next week, looking for some kind of rejection of a 30 RSI to get long. So real quick recap on the weeklies. I'm looking for a short on Apple somewhere between 191.74, 196.80. Anywhere in here next week, I will consider a short on Friday. Berkshire Hathaway, consider a short anywhere between 365, 371.20. Stop would just be high of the 922. Let's see, high there of 373.34. A close above that would be my end of week stop. And again, VIX, looking for an under 30 over 30. So I hope this was helpful today, everyone. I really do. I hope you learned a lot. Like I mentioned at the beginning of the class, or the beginning of the podcast, I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I teach a really good course. I've had so many good reviews and feedback from my students from all over the world. If you want to invest in yourself and really learn how to trade and really have good trading process, that's what I teach in my class. So all you have to do, just send me an email. The email is in the link to this YouTube video. If you like online courses, I have a great online course, very, very affordable. It's only about $12, $15. You can buy it on udemy.com. I teach you the deep dip buy stock trading strategy. I teach you step by step. I believe there's 9.5 hours of video in that course. There's 23 total videos. There's 15 study guides. And a lot of what I showed you today with these deep dip buys is exactly what I teach in that course. So the link's in the description. It's for 12 or 15 bucks. I don't think you can get anything better than that course for that amount of money. So consider that. And I always like to leave off everyone, if you could do something nice today for another human being, it really, if we all did one nice thing for another human being, it would just make the world a better place, wouldn't it? I mean, it's just logical. It makes sense. And it doesn't cost anything. Just hold the door open for someone, give them a smile, listen to them for a minute if they need to talk, but if we could all do one nice thing for another human being each day, it would be a great thing for them and for you. And if you could also go out and do something nice for an animal as well, that would be great. I was raised with so many animals, and they appreciate acts of kindness just like we do. So one nice thing for a human, one nice thing for an animal. And if we can do that, it'd be great for all of us. So I hope you have a good weekend. Next week we have Thanksgiving. So if you're traveling, please be safe. But have a great weekend. Relax. Take care of your health, do some chart study. If you have any questions or comments, please leave them in the comment section. I will do my best to get back to them. And then on the way out here, I have to run the U.S. legal disclaimer. So thanks so much, everyone. Appreciate you being here, and enjoy the rest of your weekend. And God willing, I will be back here next week, and we will see what happens in this crazy market. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.